All right, good morning, everyone. We gave it an extra minute or so. My name is Phyllis Kyle. I'm the Portfolio Operations Manager here at 1900 Wealth, and I'm joined today by Todd Brockwell, President of 1900, and Bobby Jones, our Senior Investment Advisor. This morning, Todd's going to get us started with a firm update, and then I'll talk about a market recap, and Bobby gets the most interesting topic. He's going to talk to us about what the big deal in AI is. And we'll wrap up with a question and answer period. Todd, do you want to get us started?
Sure. Good morning and welcome, everyone. We're thrilled to have you join us today for this investor call. I'll start off with a major milestone announcement for 1900. We officially surpassed $3 billion in assets under management as of September 30th. So this is a major milestone, and we want to thank you for putting your trust in us. I think it reflects the strength of our team, our long-term investment philosophy, and also the hard work that all of us have given to provide you with the best experience possible. So for that, we just want to say thank you for trusting us. We'll continue to work hard for you and new clients as they come on board. Next, I'd like to introduce Jake Allison, who joined the team. Jake grew up in Austin as a graduate of A&M, so Texas A&M. So personally, I'm excited to have another Aggie join the team. There's some others on the team that say we need to diversify outside of A&M, but we have a great addition with Jake, and he'll be working on the alternative investment team as an analyst with Matt Richter. So we're really glad to have him on board. He joined us about 2 months ago. So today, Phyllis and Bobby are going to share some insights into how we're positioning the portfolios for the future and reaffirm our commitment to disciplined growth and putting you as clients first. So Phyllis, Bobby, why don't we dive in on that?
All righty. All right. With this slide, I wanted to quickly frame how this quarter differed from the first half of the year with both the stock and the bond markets. It was a big quarter for stocks, up 8.3%. And the bonds, while took a little bit of a breather, they still had nice positive 2% returns. Cash is chugging along at just over 1%. And for the year-to-date, returns in the stock market are up 14.5%. And bonds have had a fantastic year at up 6.1%. And cash is still returning more than 3% for the year. The big picture here. We observed two broad forces that propelled each of the stock and bond markets respectively. For the stock market, volatility subsided and the market kept going up day after day into the third quarter. You can see that in the upper left chart with the volatility spike that happened during and after Liberation Day. It was followed by very muted volatility throughout the third quarter. This resulted in very few down days for that quarter and a gradual melting up of the stock market. Within the bond market this year, we saw the 10-year Treasury yields tread water during the second quarter, but during the third quarter, with negative jobs data revisions and potential government shutdowns, yields fell from the 4.4 area to end the quarter around 4.2%. And you can see on the bottom right-hand chart that drove fixed income returns higher. Okay, beneath the numbers, what's actually going on? I'm going to draw your attention to the top left charts. In the first half of the year, we saw the AI trade really take a backseat to the rest of the market. The green bar is the Magnificent Seven, and that would be Apple, Amazon, Alphabet, Tesla, Microsoft, Meta, and NVIDIA. As you can see, they move very little when compared to the other 493 stocks, which is represented by the dark gray bar. But the real story in the first half of the year was the international markets. Wow, up 17%. In the third quarter, a reversal. Look at the surge we had in the Magnificent Seven, up 17.6%. And the other stocks were up only 4.7%. Internationals up a little over 7% also. This quarter, the domestic stocks drove everything. As the end of the quarter, the S&P was up about 14%. But look at the chart on the bottom left. You can see that the S&P 500 is up almost 40% from the lows around Liberation Day. Continuing the AI trade comments, let's talk about the charts in the upper right-hand quadrant. This year, we've seen something different happening in the small cap sector. There are two popular indices for small caps. There's the Russell 2000 and the S&P 600. We like the S&P 600 because it excludes unprofitable companies, and over the long term, the S&P 600 has averaged more than 1% a year better than the Russell 2000. But this year, you can see that the Russell 2000 is trouncing the S&P 600 by more than 6%. This is really driven by the speculative, unprofitable, and highly leveraged companies within the Russell 2000. In order to contextualize the difference between the Russell 2000 and the S&P 600, we observed a significant percentage of the Russell 2000 stocks that had dramatically increased in the third quarter. This is what we're showing in that bottom right chart. This group of stocks had the common theme of AI adjacency, and they were all either unprofitable or had a balance sheet that would make a banker blush. Examples in this group include Bloom Energy, Oklo Inc., and Rigetti Consulting. Notice how the group treaded water for the first 6 months of the year, but then doubled in value in the third quarter. This mirrors the trading pattern differences in the year-to-date returns for the two indices right above it. But actually, before I move on, one more thing. This right here is where we see a little bit of irrational exuberance. I think that's worth going back a slide. I didn't want to leave that part out. Okay, I'm going to circle back to fixed income and take a little bit deeper look at this. And as you can see by the bar chart on the top, it's great news. The positive performance was broad-based. One thing I found interesting is exactly how much of an impact interest rates had on fixed income returns this year. If you notice on the chart on the bottom, you'll see that while the aggregate bond index returned 6.1% this year, the actual economic income return was only 3.7%. This means that the other 2.4% that wasn't income was market movements from the changes in interest rates. And look how impactful that was. We don't, and you probably shouldn't, count on this repeating in the future. Now, one last thing I'll mention before I turn it over to Bobby is the Federal Reserve does have a meeting today, and we are expecting them to lower rates by 25 basis points. This is widely expected across the market also. And so with that, I will wrap it up and turn it over to Bobby.
All right. Great job. Thank you, Phyllis. Well, I'm excited to join you this morning to discuss a topic that's been dominating headlines: artificial intelligence. Is AI just hype? Are we in a bubble? Is this another dot-com moment? I'll get straight to it. This time is different. AI is not a passing trend. It's the foundation of a digital industrial revolution that promises massive productivity gains and a long-term disinflationary boom. Let's start with the economic backdrop. Annual real GDP growth is hovering around 2%. On this chart, I've outlined the historical contribution to GDP growth from business fixed investment in computer equipment and software. You can see the step function increase in 2025, which we can point to as AI-driven investments. Despite concerns about elevated market levels, the reality is that we are in an economic expansion. I estimate AI accounts for nearly half of GDP growth this year, and that is not a cyclical tailwind. That's structural. AI is no longer a speculative theme. It's a foundational driver of productivity and capital formation. ChatGPT wasn't just a product launch. It was a turning point. Adoption curves that once took years now unfold in months. Just look how much quicker that product launched than popular software like Instagram and TikTok and Facebook. AI is scaling faster than any prior technology, faster than the internet, smartphones, or social media. And the compute needs are staggering. Current AI workloads are a fraction of the needs of what we'll need for tomorrow's workloads, which will require, in terms of video generation and deep research. Compute needs is not just software. It's infrastructure, hardware, energy, and labor. Now, NVIDIA's gotten most of the attention over the last few years as the poster child of AI. I found this chart really interesting. What we're looking at is the historical development of NVIDIA's most powerful GPU chips. Just 5 years ago, each chip drew almost approximately 300 watts of power. Today, the most powerful chip on the market, the Blackwell GB200, draws almost 5 times more power to operate. And the next generation chip, the Rubin, is estimated to require 50% more power. That will be an 8-fold increase in power draw from the original chips that kicked off this boom. AI is becoming a power story. We're seeing a gold rush for electricity. Data centers are now competing with municipalities and utilities for power. As you can see on the upper left, generation capacity has stagnated for over 20 years. Most of our focus on the electrical fleet has been to decarbonize legacy coal plants with a combination of renewables and cleaner natural gas. We simply haven't built enough electrical generating capacity to address the exponential needs of AI, as you can see forecasted on the upper right. How do we address this issue? Well, one solution is to simply build more natural gas combined cycle facilities. But then the problem is the companies who make these turbines are literally sold out. Look at the chart on the bottom right. The next 4 years have orders for almost double the capacity of what the 3 major global manufacturers are capable of producing, which is the gold line across the bottom right chart. Nuclear is another valid solution, but these projects are limited in where they can be deployed. Traditionally, you need access to large volumes of circulating water for cooling needs, and they typically take 15 years or more to construct from when you get approval. Another solution is to turn on old nuclear reactors that have been shut down, and that is actually occurring, such as between Constellation Energy and Microsoft up in New York. While there are promising opportunities in small modular reactors, which we are following carefully, that is still a few years away in the best case scenario. So for now, gas turbines are the most likely scaled solution for the power crunch. So why can't Siemens and GE and Mitsubishi just make more? This is what a gas turbine factory looks like. If I hadn't just said that, you'd probably assume you're looking at a NASA factory producing spaceships. This is a picture of a manufacturing facility from Siemens, one of the big 3. What you're looking at here is the assembly phase, which is typically the shortest in the whole process. The overall cycle time is typically around 18 months, with the upfront design, engineering, and materials procurement often consuming the most time. These are large machines that are mission critical and require the tightest of tolerances and technical expertise. This is not a business that is capable of or should be able to rapidly scale. One interesting observation of American ingenuity that I've observed is a Missouri firm, Pro Energy, is giving new life to old 747 jet engines as a bridging solution. They're basically refurbishing old jet engines and deploying them when permanent grid interconnections can occur and are capable of providing a temporary solution for up to 5 to 7 years. One good example of this bridging solution is a deployment in Memphis, Tennessee called Colossus One. Colossus One is an 800,000 square foot data center built in just over 4 months for Elon Musk's xAI. This facility is capable of producing 250 megawatts of computing power. That's a number I want you to remember for like the next minute and a half. For reference, 1 megawatt can power approximately 250 homes. So in just over 4 months, xAI built a factory that is now consuming as much electricity as 1/4 of the total population of Memphis. While xAI awaits permanent power supply, there are 15 to 35 on-site gas turbines to supplement grid capacity. Why is Colossus One such a big deal? Well, out of nowhere, and in less than a year, Colossus One is now the 2nd largest taxpayer in Memphis, behind FedEx, which is the global home and hub of FedEx. This is making a big impact on Memphis's economy. Beyond the property tax incentives, a typical data center project employs over 1,500 construction workers, which can make a very meaningful impact on the local economy. And a typical data center, even though Colossus was built in 4 months, realistically, a typical data center construction phase takes 3 to 5 years. And then there's a multiplier effect on the employment for lasting into the future. Now, to conceptualize the pace of growth and the scale of dollars and investments, let's look at Mark Zuckerberg's tweet from July 14th of this year announcing Meta's Project Hyperion in Louisiana. Just literally look at this building. It is the size of Manhattan. This project is aiming to deploy 5 gigawatts of compute. This is equivalent to 20 Colossus Ones. This project is so large that Entergy has approval to build 3 new power plants. and that will only supply half of the electricity. To finance the costs of this massive project, the joint venture between a major private credit firm, Blue Owl, and Meta just completed a $27 billion private placement of debt, financed with A+ rated private credit. This is the largest ever financing like this of its kind by a long shot. And this is not speculative capital. This is institutional capital, and it's being deployed at scale. Incredibly, PIMCO's clients bought $18 billion of the deal and has reportedly already booked almost $2 billion of gains. And the party keeps going. I won't go into detail on all of these, but this is a non-comprehensive list of hyperscale data centers that I found just combing through the news. It is an all-out arms race for power and compute. What is the prize at the end of the road? The global AI market is projected to grow from $280 billion today to $3.5 trillion by 2033, an almost 31.5% compounded annual growth rate. This clearly represents a massive opportunity. An opportunity attracts capital. While there's clearly opportunity, it is not totally clear exactly who the winners will be when the frenzy is said and done. Will it be the semiconductor manufacturers? Will it be the network providers, the cooling and the power infrastructure, or the application providers who we may or may not know yet? There are multiple ways to invest in AI, but I caution they will not all win. While I'm fundamentally positive on the direction of the construction and adoption of AI and the positive impacts to productivity, I believe it is dangerous to focus on an investment in any one firm. And in particular, I would refrain from expressing any investment in a small speculative startup. Pulling it all together, I appreciate this analysis from Goldman Sachs projecting that AI will begin to materially boost US gross domestic product starting in 2027. This is why AI is a big deal. It's a big deal for those businesses that ultimately win the AI race, but it is more importantly a big deal for all, as it is projected to durably increase the economic potential of our economy overall. A rising tide lifts all boats, and I believe that is what will unfold for the US economy. Thank you all for joining me this morning. I know we covered a lot of technical ground, but my goal was to show that AI is far more than an app on your phone. It's a foundational force shaping today's economy and the future of growth. So when people ask, is this another dot-com bubble? The answer is no. While there are parallels to the late 90s, two key differences stand out. Number one, AI isn't just about productivity. It's about sovereignty and defense with real national security implications that the dot-com era never had. And two, experience matters. Today's executives understand the risks of boom and bust cycles and are far more disciplined than in past bubbles. Put it all together, and we're in what feels like a modern Cold War, a global AI arms race anchoring a digital industrial revolution. And I'll bet on America leading that race every time.
Okay. Let's take some questions. Okay. Oh. Let's see.
Okay, so we've got one that says, called the AI trend a deflationary boom. Assuming that's true, do you believe we can count on the government to continue to debase the currency fast enough so that we as investors don't get squeezed by falling asset prices, which are often associated with deflation? No, I think when I said deflationary boom, what I think that means is that, look, there's going to be job losses. There's no way around that. I think that looking forward, the productivity enhancements are going to come at the cost of traditional jobs that we know of today. Now, there's a debate on whether or not there will be replacement jobs that we don't know of yet. So if we think about the horse and buggy analogies as it related to the automobiles coming out in the early 1900s, there's debates on whether or not we'll be the same way this way. I think one way or another, one thing that is super clear is that tasks that used to take days can now be done in fractions of a minute or 10 minutes from computers. And I think that that trend is only increasing. And so I think that the prices of almost everything are going to come down. I think that that's going to accrue to the benefit of companies and corporations and their owners. We've seen major announcements out of Walmart that they don't plan to hire anyone again. We've seen announcements out of Amazon that they're reducing workforce. Look at Waymo that's now driving around San Antonio quite significantly. Those are basically Ubers without drivers in them. And I think that it's going to be a long-tailed conversation around how society adapts to all of this. But the one thing that I think is critically clear is that corporations are going to be the big winners here. So that's a great question.
All right, do you want to, we did have some that were sent in before we started today. So I'll start if you want to read
Yeah.
those out. All right, the first one, are we seeing any impact from the government shutdown? I'll take that one.
Why don't you take that? You've done the
Yeah,
work.
we actually looked into this before, and I mean, no. The answer is no this time. No measurable impact so far. Not saying we won't see one. It's been 30 days, but in the past, oh yeah, that's right. And since it shut down, we're up about 3%. So we're actually better than the average. When you look back at the 20 shutdowns we've had since 1976, the average duration was 8 days, and on average, the markets were down 1.4%. So we're up this time. And then if you look again at the history back, if you look a month after we reopen, we're up 1.7% on average. So a nothing burger? Is that? So no, nothing so far. Remains to be seen when we get this thing wrapped up. Okay, let's see. You want to take? Let's see. Well, there's one with PE valuations so high. Do we see a looming AI bubble? I feel like Bobby covered that one pretty well already. Okay, how do we feel about emerging markets as returns are above 20% this year? Should we increase allocation to that segment of the market?
Yeah, so despite strong recent returns, I continue to remain cautious on most EM businesses. Political instability often drives outsized economic or currency risks, and there's always a risk of confiscation or a lack of appreciation of contract law. The only market with scale in terms of talent or innovation or capital is really China, but structural and geopolitical reasons kind of keep me on the sidelines there as well. So, when I think about stock investing, equity investing, it's all about innovation, growth, and nobody really has that potential outside of the U.S.
And what we've included in the portfolios is an active approach to EM exposure, so we can limit the ability to get the large exposure that China has in just the EM index. So we're taking an active role on what Bobby just alluded to.
And I just see we have some more questions that have come in. The next one is, will small nuclear reactors have a positive impact on the AI power challenge?
It's a great question. And it's something that I kind of alluded to. We're following pretty closely. So Matt Richter put on a phenomenal symposium for those of you who were able to make it. And we had an illuminating, just visionary come and present. And one of the companies that's trying to commercialize small modular reactors, I think they clearly have a place. I think that our administration is supportive of fast tracking whatever regulatory process are needed. And the most near-term timelines are hopefully next summer. We'll see some of these reactor cores turn on. There's already contracts being made by major hyperscale data center providers, and these companies now, that's going to be contingent upon regulatory approvals. It's going to take time. So I don't think that that's going to come to the fray anytime soon. I think that more of the temporary solution will be actually things like old gas turbines that are put on in a temporary fashion. But I think part of the permanent solution will be these small modular reactors.
So we've talked to a couple in this diligence of looking at power being a key issue for AI. We've talked to a couple of senior leaders out of the private sector, i.e. in the military, and some of these small reactors are currently being used on the government side. So we're as much as we can try to get insight there. We're going to monitor that closely also.
All right, and then we have another one. Where is all the water for cooling going to come from?
This is a real problem.
Yeah.
There's a lot of real pushback right now on a lot of municipalities. And we're seeing some data center projects getting kind of some of the NIMBYism, both from water as well as from potential job losses and the potential for electricity prices to go up in the jurisdictions where some of those job losses may come from. It's an ongoing deal. I think that one thing that will be favored is much more closed loop cooling systems. And I think that technology will solve that problem.
That's we at our alternative symposium, we had a speaker that addressed that question directly, and there's some evolving technologies that will provide not the silver bullet, but provide at least a solution, we think, for water being a key issue.
And it looks like the last one we have up here, what is happening with credit spreads in both the high yield and investment grade spaces at present? Yeah, I'll start. You can chime in.
Yeah.
They keep getting tighter. We did take a little bit of a breather at some point in the third quarter, but if you recall from the chart on the various sector performances, both investment grade and high yield have outperformed treasuries this year because the spreads have been tightening. And at this point, we're within 5-year averages. So we'll see. People thought they were tight at the beginning of the year, and they've just gotten tighter. So I mean, it's on the back of strong, stock market performance and healthy returns this earnings season.
Yeah. No, I'd just say credit fundamentals are positive across the board, and the consumer continues to be pretty resilient, surprisingly so, much to our chagrin as well as some others. And as a result, spreads kind of reflect that. There's been a few notable credit events that have occurred in the securitization market as well as private credit adjacent markets. We're seeing some notable fraud issues crop up. And I think, the best way to address, and what I would say is that of the credit issues we've seen, it has been fraud. So it hasn't been an issue where because somebody's business model has changed or because the cost of financing has changed or an input into their manufacturing process, they can no longer meet their obligations. It's been just outright fraud. And what we're doing is, we're having a very proactive dialogue with a lot of our partners about it, but more importantly, diversification is really the main strategy to mitigate the impact of potential fraud. And I think that it's been a wake-up call for a lot of regional lenders, a lot of private credit lenders, and the credit space overall. Clearly and succinctly, we do not believe that this is a systemic issue of any shape or form. And I think that just kind of looking at overall public market spreads is a better barometer for the health of credit markets generally, both public and private.
Let's see, do we have any more?
I think we got time for maybe one more, or else we'll violate Todd's promise for 30 minutes.
He did, I know. Well,
our goal is to keep it 30 minutes or under, because I know y'all are all busy and we don't want to bore you to death.
All right, let's see this one. Related to the shutdown, is there concern about economic reporting to make sound decisions? And going forward, what about the confidence in the data of those in charge are removed and replaced with those more loyal to the administration interest?
I'll take this. That's a good one.
It is a good one.
So, I think if we've been paying attention to what's happened with the unemployment market this year, almost 1 million jobs evaporated, jobs that we thought that we had. So previous Fed governors were making decisions based upon data that is now proved to be inaccurate. So to a large extent, we've been flying blind throughout the last year and a half. I would say that, look, we've got deportations going on. Job growth is slowing. Productivity is also helping to slow job growth. But generally, corporations are in strong position, and the personal balance sheets are in strong positions as well. And so, I think those who are, quote, more loyal to the administration, I think there is going to be a little bit more coordination. And as it is, I would say that the market is anticipating that short-term interest rates are going to come down to about 3%. That's the range that Treasury Secretary Scott Bessent thinks that it should be at anyways. So it seems like the market is already kind of gravitating towards where the administration thinks that it will be. And if we have, a new Fed president come in who is, or a Fed chair come in who is, viewed to be more loyal. I don't think the market is anticipating that there will be anything much of a surprise. I think it'll be perceived to be a bit of a relief because, the only areas of the economy right now that are being held back is primarily interest rate sensitive sectors such as home building and the household sector. So generally, I think that it would be kind of a bit of a relief. So all eyes, continue to be on inflation, and it's hanging in around 3%. So even if it's somebody more loyal to what our president has indicated that he wants to see, the Fed has said they've got a 2% goal, and so they would have to abandon that goal in order to make any material major changes. And so we will see.
Let's jump real quick. The question is, do you think the Russell 2 is closer at the top for this cycle? There was a slide that Phyllis showed earlier that really carved out the momentum piece of the Russell 2, but overall the Russell 2000, the valuations are still compelling relative to large cap. So I'll just make the comment that there's probably room for growth there still in the Russell 2000 and the S&P 600. But Phyllis's point is well shown on the Russell 2000 has really been driven by that kind of speculative AI space. So,
and go back to, the market's up 40% from Liberation Day. So if we've learned anything, staying in the market is what matters the most.
Yeah.
Not trying to time.
Yes, I know. Do we need to wrap it up? I'm
Yeah,
looking at the
let's-
clock and I'm
I
going,
know.
I know we have a schedule to keep.
This is like the most questions we've ever gotten.
I
I just
know.
want to say thank you.
Yeah, thank you all for participating so much.